for 2018 that gives you a little fortune telling. So pick it up on your way out on the checkout desk. And these are our partners. As you see, we have a lot of partners starting from China Institute, Committee 100, Asia Financial Society, and all the way down. And what we love to do at SEP China is to aggregate news and give our original content. In the same way, we're including all our partners who promote U.S.-China relations, and we're thrilled that they have been wonderful partners with us today. So now I want to introduce us to my partner today, who is jointly hosting this conference, James Heimowitz, the president of China Institute. James, can you please stand up just to give a quick bow? So, as you know, China Institute is the oldest institution that promotes U.S.-China relations and has 3 pillars: culture, language, and business. And we have almost 300 events a year, so I hope you'll come and join. I say we because I'm vice chair of China Institute. So let's continue our wonderful program this afternoon, and let me introduce you to Soraya Darabi, my partner at SUP China, who, by the way, has won many awards, 30 under 30 and 40 under 40, and has started the digital media at New York Times and is on her way to Davos. So Soraya, take it away.
Anla is too generous, as usual. So good afternoon, everyone. As Anla mentioned, partner to SUP China, an investor, an advisor, and the biggest reader and biggest fan. And for those of you who just need a brief reminder, SUP China is short for What's Up China, which is an independent digital media company informing and entertaining a global audience of influencers and leaders with smart, accessible content, helping them make sense of a very complex country reshaping the world. And through our app, newsletter, website, social media, of course, and podcast, SUP China provides a feast of Chinese news and information to enlighten you all. Wendy, founder and CEO of Honest Capital, will moderate this panel. So thank you to everyone who's attending, and thank you to our Fan Nice panel for coming on stage.
Okay, good afternoon. I hope everybody had a good lunch. Those cookies were delicious. I had 2 myself. So now we're fully awake. Okay, so we're gonna get right into it. I know the clock is already on, and we have an exciting panel. I myself am very much looking forward to hearing from each one of my panelists. I had the pleasure of talking to them via phone a few weeks back, as 2 of them flew in from Asia, one from Singapore, one from Hong Kong. So we actually had the pleasure of chatting about some of the recent developments in the marketplace, both in Hong Kong, in China, as well as in the US. So we'll get right into it. So we'll start off with having each one of them giving a little bit of brief background on what they do, what their firms does, and then we'll get into our the stock market, actually, since it's going gangbuster over in Hong Kong. Okay, we'll start with you.
Hello, everyone. I'm Joseph Zeng. I'm the CEO of Greenwoods Asset Management in Hong Kong. We are the largest and earliest and one of the best performing China-based hedge fund managers in the world. We manage over $10 billion in total AUM. And we're known for our fundamental bottom-up research, focusing on grassroots analysis of Chinese companies.
Rick?
My name is Eric Alvarez. Hello. I am one of the founding partners of Apis Capital Advisors. We were founded in 2004, and what we do is we perform fundamental research on companies on a global basis. And what we've looked at over the years on a global basis, obviously the importance of China and the impact it's had on so many different countries and companies, and it has drawn us into China, a lot of names that are impacted by what's happening in China. Over the course of all those years, we watched a lot of cycles, and the latest, I think, big one is what's happening in technology and in a number of different places as well. But we'll get into a bit more of that later.
Hi, my name is Kenny Jan. I came from Singapore, so I apologize if I look a bit dazed because I'm a bit jet lagged. Now it's about 3 a.m. Singapore time. I came from Value Partners. I'm the CEO of the Singapore office and also one of the investment director for the group. Value Partners is one of the leading asset manager in Asia. We manage about $18 billion US. Currently, we are focusing on predominantly Greater China equities. And over the past few years, we also have diversified into fixed income. We run the biggest Greater China high yield mutual fund in Hong Kong. And anyway, this year has been, this year too has been a great year for the Chinese equity market. So, I look forward to the panel discussion.
Yes.
So my name is Yang Ma. I recently joined the Bank of China, New York, here locally. And prior to that I was with Morgan Stanley. I was a COO/CIO for risk management, and doing all kind of stuff. I always quantify myself doing computer chairs and the desks. Of course, more than that. And then before that, I was with IBM Research, and also joined Goldman Sachs because at IBM I'm doing useless research, so I thought it's a good idea to come to Wall Street. So Goldman Sachs, Merrill Lynch, and 10 years. And then in 2009, I joined Lehman Brothers. So you know what happened. So I make a go under, so I can switch another job. So therefore, today's panel is about investment. So my job is twofold. Number one, make sure their investment advice has risk control. So I have to approve it before I can buy, okay? Number two, because right after lunch, I make sure you guys awake. Looking forward to it.
Well, Dr. Moss specifically asked if he can sit at the end to anchor, bookend this, so that as he's being the risk manager, he's going to essentially keep us all in line. So we'll start off with the market. So the market was tremendous last year, especially in China, and it's looking quite robust already in the first 2.5 weeks of this year. I think that if you look at some of the key statistics, the trade data looks good, PMI is exceeding expectation, FX reserve is rising. I think the two big catalysts that's been well discussed, especially this month, has been the so-called full circulation of A-share, as well as in the mainland, they're expecting to lift the ban. It says here that a ban on major owners selling shares of state-owned enterprises, which is going to be huge. And secondly, it's really about changing the IPO rule, right? Allowing dual share listings on the market. So how do you guys foresee the impact on the overall marketplace in 2018, and also specifically to each one of your investment strategies? We'll start off with sitting right next to me.
Well, first, we believe policies are very important for China equity markets. Specifically on this two, the first one, there was a precedent in 2006. That was a year after I returned to China from New York. There was such a kind of reform happening in the A-share market. It's called non-tradable share reform, which basically is to permit the largest shareholders, which are the state government, to make their equities sellable into the market. And the government compensate investors for that. The average compensation was about 17%. So if you are a public shareholder and your government shareholder, they want to sell their shares, they need to compensate the public shareholders for that. And again, the average was about 17%. Some government pays some shareholders more and some other shareholders less on different companies. Now this is going to happen in the Hong Kong market, announced it at the end of last year. It's a pilot program, and as of now, I heard there are 3 companies started in this pilot program. There are different opinions about this. Some managers believe this is negative because it means it implies an increased supply to the market because the government owned the shares which were not tradable, but after this reform, they'll be tradable, so which means increase of supply. We argue differently. Number one, based on the precedent, as I mentioned, that in the A-share market in 2006, at the beginning, it was perceived as negative also, but eventually investors realized this is a very, very important system because it aligns the interest of the government with public investors, including funds, including retail investors. Because think about it, if the government, as the largest shareholder of those listed companies in the Hong Kong market, so-called H shares, in the A-share market, if their shares, their ownership, cannot be monetized into the market, they don't have the motivation. The government, as the largest shareholder of those companies, they don't have the motivation for their companies to perform. So as a result, quite some Chinese companies, they didn't pay dividends for a long, long time. And if the largest shareholder, they don't care about the interest of the public shareholder because they don't benefit from the share performance of their stocks, how can you invest into these kind of companies? So we believe this reform can actually help align the interest of the government shareholder and the public shareholders. It will also make M&As more active in China equities market. One of the key differences between China equities market and the US market, you may not agree, but for me, is the lack of M&A activities in China equities market. Why? One of the key reasons is because the largest shareholder there is the government. And the government, they cannot sell their shares. So as a result, M&As are not active. But after this reform, we believe we can foresee more M&A activities in the market. We can even see some control deals, because if the government is motivated and they want to exit from some business, then it means privatization opportunities for the market. These are long shot. These are long-term positive for the market. But in the short term, yes, there could be increase of supply of shares to the market, but we don't foresee that to be significant because the government, as of now, they don't have a plan to monetize from their holdings. But to have the capability to do this is important. So that's on my quick takeaway on the first point. On the second point, the relaxation or / innovation of Hong Kong Stock Exchange in terms of IPO rules, I think that's very, very significant. Because number one, we can spend a day about this, but long story short, Hong Kong Stock Exchange is going to permit companies with different share classes, like Class A and Class B shares, to be listed in Hong Kong. They didn't do this. And that's part of the reasons that Alibaba picked the US market for their IPO. And Hong Kong realized in this new economy, in the current world, the senior management, they need to have more voting rights. And that's why they started as a reform. This reform is not finalized yet, by the way. But I think it's very, very likely to be approved eventually. So the first reform is they're going to approve companies with dual share classes to be listed in Hong Kong. The second one is they are going to permit biotech companies specifically to be listed in Hong Kong, even before they have revenue, not profit, revenue. So this is very, very innovative, and it's similar to the NASDAQ listing rules. The third reform of Hong Kong Stock Exchange is they're going to permit dual listing of companies listed somewhere else, such as the US, to be listed in Hong Kong. So people are making speculations that whether Alibaba, JD, these kind of companies can be dual listed in Hong Kong. Liberalization is always a thing driving China's equity markets. And one of the outcomes of this reform is we believe this will, on one hand, encourage innovation in new economy companies in China to grow faster and be listed earlier. But another impact is on the A-share market. Because in the A-share market, there are basically two camps of companies. One is blue chip, large cap, high quality companies. And the other are smaller, high growth companies, but they're traded at very high valuation. Even now, their valuation are still traded at mid to high double digits. Some of them are traded at triple digits in terms of price to earnings. We think this is not going to be sustainable. So we believe the relaxation of the listing rules in Hong Kong, if approved, would create a pressure for these small cap companies in China, because those new high growth companies, they no longer go to China next market for IPOs. They can go to Hong Kong for IPOs. So that could create some impact for those small cap companies in China. Those companies in sexy business such as robotics, AI, biotech, they could face the pressure.
Okay.
Yeah, I mean, I would agree with a lot of what you said, and I think particularly anything that brings more fundamental investors into a stock and actually removes passive investors like the government, it brings a degree of say, critical eye to the name, and I think it makes for a much more efficient market. I think a lot of the reason why you don't see the M&A, for example, in the market is you don't have the incentive there. You don't have the investors knocking on the door of management and saying, look, you've got to do something to realize value. And that should improve. When I look at the country from a global perspective, we're often comparing different opportunities across different countries, and China has a lot of issues. This is one of them. I think some of the other concerns that people have are around the currency controls. So the extent that being able to list in Hong Kong, et cetera, addresses that would make a big difference. The corporate governance issues, a lot of times people will bring up being able to take a majority stake or be able to force M&A will begin to repair that as well. So yeah, I would agree with a lot of what you said.
Kenny?
Yeah, I just think that whatever the government is doing or the regulators are doing right now is good for liquidity. And when the liquidity is good, the market will benefit. I think a very clear example is the South Connect, whereby I remember beginning of last year in early 2007, after the new year, I went straight to Beijing and I met up with a lot of local managers there. At that point in time, the whole mindset was just thinking the Chinese renminbi will just go one way, that is to depreciate. So there is a lot of ways of finding money to get out of China. And as a result of that, the Chinese government really tightened up the capital outflow risk to prevent money from flowing out of China. At that point in time, I tend to take a more contrarian view because like my company, we tend to be a value investors and we tend to take contrarian view. And we, at that point in time, took a view that actually we do not think that the renminbi will significantly depreciate. In fact, we see little depreciation pressure at that point in time where it was hitting close to 7 against the US dollar. But I think one thing, the mindset of the mainland Chinese investors is that South Connect, my money can go to Hong Kong. Hong Kong is pegged to the US dollar. So as a result of that, Hong Kong, the H share became even the Hong Kong listed share became a very viable investment option for the investors in mainland China. And in the past, they did not have very good experience, but last year was a great experience. So they actually benefited significantly from their investment into the Hong Kong market. And again, back to Wendy's question on the kind of listing reform that the Hong Kong market is contemplating, whether it's the dual class or whether it's the H share liberalization of the non-tradable shares, as Joseph has alluded to. I think all this would mean that there will be a lot more opportunities for investors to invest. Let's say if they do not want to invest in the domestic Asia market, and the Hong Kong market will become a viable source. And from a valuation perspective, it is still trading cheaper in terms of valuation than the domestic markets at this point in time.
See, this is what happened. So when I'm doing the risk approval thing, those guys spend all the time. So but come to me, only 2 hours to prove. So they all took all the time. I won't be brief, okay? Not a complaint, just an observation. So my take is 2018 is adjustment year. Because given the new leadership, given the initiative that China has taken upon, in terms of business opportunities, even though I'm risk manager, but I can see international and domestic. In the international area, we all know Belt and Road Initiative. For example, the business can see opportunities in the initiative such as like a port in Kenya and the railroad in Hungary and the free trade initiative in Kazakhstan. Those are the opportunity from your perspective you can take into that. That's the hard power initiative. But there's other aspect that some people may not be pay much attention about. I call soft power initiatives, which is something like the Chinese culture initiative, like a culture in universities around the world. Those are the stuff people do not necessarily link it to the investment. This will translate into what? Into the media company and into the educational stuff. Those are something we want to take a look at. And that's the international area. Domestically, we all know this. healthcare is going to be big in China. People are getting rich, people are getting older, but they need to take care of that. That's the initiative, but may take a long time to get there. And lastly, I will mention that the environmental protection. As a matter of fact, 7 or 8 years ago, I even advised my sister's son to study environmental area because that's the area we all know the air pollution is a big deal. So if you think about investment, not short-term investment, those are the areas that I would recommend you to consider.
Well, thank you. Actually, I would love to explore the M&A point earlier, because based on what I just heard, there's a lot of these liberalization of the market and et cetera, is to encourage a lot of domestic activities, right? So if you look at the latest Central Economic Work Conference that took place on December 20th, it outlined 3 key goals from the government: curbing systemic risk, poverty alleviation, and environment protection, right? Again, domestic. Right, very much so. So coupled with all the tightened capital control pressure, especially for those of us sitting here, spending time in New York, that we have felt a real impact in some of the key sectors like real estate from the capital control measure. So is that a step away from going global strategy that was much talked about in the previous sessions, right, in the last few years? Was that a deliberate break aside from some of the monetary policy issues? And do you guys all foresee that the focus will remain to be encouraging more M&A transaction domestically rather than cross-border, right? And how does that come back and to impact your investment strategies? And anyone? Joseph, you want to
Let me start, since I just talked already.
All right.
So I'm the risk guy, so let me talk first.
Oh,
in terms of
actually,
going
Dr.
global,
Ma, if you don't mind,
Okay.
Since we're starting with the risk manager, I want to couple with the fact that the Huawei deal and the Alibaba deal
that's
that
right.
fell apart.
Exactly.
And I saw that in the South China Morning Post, one of the former Chinese Commerce Department official actually said that China, Beijing should take countermeasure. Okay, so none of this is very encouraging.
Yeah.
From in terms of the whole going global strategy.
Yeah.
So I would love to
Well,
hear
I
your
answer
comment.
2 aspects. One is the going global strategy. I'll give you some stats. As of the 3rd quarter 2017, the overseas acquisition compared to 2016 is down 67%. That's we already know. Given the control from one side and given the resistance from other side, you know what I'm talking about it. But I think 2018 will be a slow recovery year. And also, I think the slow recovery will pick up in 2019 as well. This will lead into 2020 election. So therefore, both sides need that. So I think it's a temporary pause. 2017 could be the bottom of it, but it's also the slow recovery. And in terms of systematic risk, you talk about it, I think systematic risk domestically in China, they worry about what? They worry about a financial product that issued by the companies such as wealth management company, insurance company, online micro lenders, those kind of stuff. They worry about this kind of product eventually will create a systematic risk in China. But I was in China about a few months ago attending a big conference organized by the central government. And as of now, I think they're doing a great job. These things are already gone. So therefore, having said that, they continue to control, like shadow banking, that kind of stuff. But the benefit of those controlling will, is prevent systematic risk, which I don't think will happen in China. And secondly, they will benefit the traditional banks, like the Bank of China ourselves, and the fund managers as well. Let me keep it brief, so let other people talk.
Okay, all right. Then from an opportunity standpoint.
Yeah, I mean, I think in terms of going overseas to make acquisitions, it was interesting watching this in the early part of the 2000s, the mid-2000s. A lot of the money was going into heavy assets, going into mines and whatnot, and I think there were some pretty massive losses that were taken on those investments. Now, fast forward to today, and what you're seeing is a different type of M&A that's being attempted overseas, maybe a lot more along the lines of trying to acquire intellectual property. And then the governments are getting involved and saying, no, you guys can't have that. So you saw it even going back, I think, a couple of years with little names like Axtron in Germany in the semiconductor space or MoneyGram recently. I think that what it tells you is that China needs to develop its own intellectual property internally. They need to invest in their own R&D because it's going to be hard to acquire overseas. So the companies that have the means to do that and that are going to actually spend the money and develop that technology internally will probably have an edge because I think it's just going to be really difficult to go overseas and buy it. So that's, I think, one important takeaway of what we've learned over the past 12 months.
Okay.
Can I add a few
Joseph,
words?
yeah, please.
Well, I tend to agree with Eric's point. I believe Chinese government's policies are a little bit misunderstood or misperceived. Before, a lot of Chinese investors, they invest into, for example, entertainment business in the U.S., movie theaters, this kind of business. They're not supported by Chinese governments because they more and more realized the money needs to be spent in a wiser way. So we still see transactions such as, for example, some of our portfolio companies in the healthcare business, they invest into drug companies in the U.S. One of our portfolio companies invests over $400 million to buy the drug companies in the U.S. And we have also seen, for example, GE's home appliance business has been sold to one of the largest Chinese home appliance maker, Haier. Toshiba's home appliance business was sold to Chinese. Panasonic home appliance business has been sold to Chinese corporates. On the private side also, one of our portfolio companies, Tencent, they invest into the largest online car service company in Southeast Asia called Grab. We invested into that deal also, so we know it, without any government restriction. So I would say the investment by Chinese corporates or investors into leading companies with technology advancement or with new business models, they're still approved. So there is a risk to generalize this.
Okay. Kenny, you have anything to add?
Yeah, I tend to agree with Dr. Ma's comment that the M&A activity perhaps may have hit a trough last year, and that's largely because of the capital control and really China tightening the screw not to let too much money flow out. And at the same time, I think it also hand in hand with what the previous panelists mentioned about, deleveraging, de-risking actually is about the same thing. So there are a lot of number of the pretty well known by the media right now companies with very poor balance sheet trying to acquire a lot of offshore assets. So I think that is not what the Chinese government wants to do. At the same time, taking a view that by doing this, I'm actually sending a wrong message to the corporates that you can do whatever you want, regardless of how risky your balance sheet is. I think that is definitely a no-no. But on the other hand, as what Joseph mentioned, there are certain industries, certain sectors that the government is actually encouraging, M&A activities, and they will not, put a stop to that. And I think this trend will accelerate in the next 2-3 years, especially if the pressure on the currency is actually, behind us at this point in time. And again, the economy is entering into a stabilization phase with a stable political system. So I think the worst of M&A may be behind us.
Okay.
I would add too, just on domestic M&A, the environmental push that they're making, and you're seeing a lot of industries where there's a couple of leaders but a long tail of producers that are very inefficient. You're seeing those getting closed down in a lot of small places or a lot of small industries as well, where they're just inefficient and polluting, and there's no reason why that's not going to continue, I think.
So it's pretty apparent that there are sectors that's much supported by the Chinese government, that's aligned with the overall guiding principle. But then there are industry that, even though it's discouraged, but most popular among investors, one of them is real estate, right? So China has gone through a few rounds of trying to tighten it back in terms of over speculation investment in the real estate market, whether that's residential or commercial, as well as overseas investment. Part of the capital control measure that took place was precisely to also ease some of these non-strategic investment into some of the popular cities in terms of real estate. So, however, recently there seems to be some easing in terms of extending credit to first-time home buyers. That's domestically in China, and that it's for the first time, right? The market, it has tapered off and even slightly trending year to year, slightly down in the China domestic market. So, any comment to one of the most popular sectors? I took a look at some of your portfolios. I know that you guys are not really in that market, but most Chinese companies and all have something in real estate. It's been impacted here in the U.S., so I'm sure the audience will love to hear your view on just the overall sentiment towards the real estate market investment as a sector.
Maybe I'll kick off since we do own quite a lot of property stocks in our portfolio. In fact, our fixed income fund has a large concentration of names in those property companies. I think there is a myth in terms of what the government is trying to achieve. The government is not actually trying to stop prices from rising, but I think they want a more measured pace of increase in price. But Chinese being Chinese, as you know, you go to a casino and typically you see what are the people there on the gambling table. Most of them are, no offense, are mainland Chinese. So I think the instinct to make money, the instinct to speculate, regardless of whether it's on the gaming table or whether it's in the property market, they just like to do it. So, and what we have been seeing in a lot of the Chinese market, in fact, one of the, I think the earlier panelists on the economy, talking about the Chinese economy,
macro, yeah.
The macro.
Macro.
I think he actually made a very good point. If you look at the price rise in the first tier, second tier city, that actually is phenomenal. Everybody got scared when they look at the price. But you go to the smaller cities, the price increase is much more moderate. So I think we are just focusing on 3% of the market and then concluding that the Chinese property market is in a bubble. I think that is a very a very generalization, or perhaps a wrong generalization of what the Chinese property market is. Back more specifically to Anla's question, and to Wendy's comment on the property market. I think the important thing that one has to understand is that the government is not trying to stop first-time home buyers from owning property. So as a result of that, I think they have relaxed a bit of measures recently. But that does not mean that the government is encouraging people to speculate in the market again. I have visited quite a number of property companies over the recent months. And the kind of general message that I tend to get is actually quite comforting, in the sense that on one hand, they are not trying to raise prices significantly. On the other hand, they are acknowledging that inventory is actually depleting, the land bank inventory, but they are not going out there to buy land at ridiculous prices. In fact, they take a more cautious approach in terms of land banking, so that so the conclusion that I have come to is that we are likely to see a moderate rise in property prices in China. The anti-speculation measures will still be in place. So, if you think the government will let go of all the restrictions, I think that's not going to happen. And thirdly, if you look at the balance sheet of a lot of the property companies, with the exception of one or two, they are in a much better shape than they were a couple of years ago.
Great, thank you.
Yeah, I mean, I would just add, is anybody who I think comes to China who's an outsider, especially somebody who is invested through the financial crisis here and saw the property bubble, they look at the valuations, particularly in the large cities, and it's exasperating. I mean, I think Shanghai is 30 times valuations are 30 times the average income. Yeah. I don't think you can invest in China without having some understanding or appreciation for the property market in China and understanding the real estate dynamic. With that said, I think it is kind of a conundrum. It's hard to figure out. You have a closed system. You have a currency that isn't freely traded. It's very difficult for people to put money into other assets, including the stock market. It's still perceived to be largely a speculative place and not a place where you save for retirement. So real estate is really the go-to investment. And when you talk to a local person about what they're doing with their savings, 99% of the time they're looking at property to buy. So it may look really overvalued, but that could also last a really long time, I think.
Okay.
Let me make a comment too. I will talk about U.S. market. Wearing the risk manager hat, that one of the worry I have is real estate market, because you mentioned about what the concentration. Concentration is something we have to avoid. And not only that, the U.S. Real estate market normally lasts about 15 years. It's a cycle. So the one was last, peak was about before the financial crisis. So it's about 10 to 12 years already. So the worry we have now, given the fact, if not because Donald Trump's administration's initiative about the tax reduction and so on and so forth, so it's about the time now that the property market went up like through the roof ever since 2009. So we needed to pay attention to that. But having said that, if the U.S. market, real estate market, have the problem, what does it mean to the Chinese market? Of course, the Chinese market is a little bit different because on a different set of equilibrium kind of forces going on. But still, we needed to pay attention. If you are thinking yourself or your business think about self, it's the time that I begin to worry about the real estate market in the U.S.
Great. I want to make sure we have enough time to cover key sectors that are probably most relevant to this audience. We cover the real estate. The other one is financial services sector. And let me come back, and then I want to talk about also the electric vehicle, the AI market. China seems to be trailblazing in that area. And then lastly is the fintech. So coming back to the financial services sector, back in November, Finance Minister Zhu Guangyao actually said that China is going to allow foreign companies to own 51%, right, of Chinese securities firm, fund managers, futures companies, and that in 3 years' time, they will allow foreign ownership to 100%. Any comments, any insights from you all in terms of what that means for you guys and for our industry?
I mean, I think in the asset management space, the business that we're in, it's probably a huge opportunity. This goes along with some other reforms that will have to happen, but Chinese invest about 1% of their assets overseas, just in general, as a percentage of their savings, versus 20 to 25% for most other developed countries. And so when you put those percentages to actual numbers, they're huge. They're in the trillions of dollars. People will go over there, and they are already to take advantage of that, to try and help that domestic investors invest overseas. So that's one change that I think we're already starting to see.
Okay. Just really quick, and I do want to get perspective from the three other panelists, is that, as we all know, it's similar industry firms here is highly regulated, right? We're talking about multiple regulatory agencies, SEC, if it's banking, OCC, FDIC, you name it, FINRA, it goes on. And there's been such a resistance, or reluctance, I should say, right, from allowing Chinese investments to even have minor ownership in these firms. So as we continue to get comment from you, I would love to also get your feedback on that. I don't know, Kenny, if you want to take it.
Yeah, actually, this is a very interesting development for me. I just kind of rewind my time back to when I was at Goldman Sachs. I was actually at 2004 setting up the China business for the Goldman Sachs asset management business in China. At that point in time, we were contemplating whether we should do a joint venture model, but then we recognized that, hey, we will be a minority, and there will be a lot of cultural difference that we let's say we find a majority local partner to joint venture with. So at that point in time, I think the challenges, the risk of having a partnership was relatively overwhelming. So we decided to go by ourselves. So we started from a rep office and gradually, but we never got the the local mutual fund license, which is the most lucrative part of the China fund management business. But with the change in regulation right now, I think the foreign firm having control, I think that basically will have a significant change in the landscape, because at this point in time, you really can do what you think is more appropriate, at least on a more controlled manner, that you can actually exercise more majority control. Of course, you still have to deal with the regulators then, but I think the overall regulatory environment will be made more conducive, for foreign asset management license to actually operate in China. A case in point is recently you can see that they have also been awarding a lot of the private fund management license. We fortunately was one of them that got a private fund management license in China just in November of last year. So I think that opens a lot more opportunity for us to, as what Eric mentioned, perhaps sell products in China, and hopefully, when the Chinese money are in a more position to go to invest overseas, we'll be able to, perhaps assist them in this wealth management function.
Dr. Mark, would you like to add, because I know that as Bank of China
Yes.
have gone through various different phases in the last 2-3 decades in terms of licensing in the US, as well as dealing with US companies trying to access the China market?
Yes, the regulation is hurting a lot of banks, including domestic bank as well as the foreign banks. Since 2009, we all know that they have Dodd-Frank, the act, as well as the CCAR. After 7 years of doing CCAR, all the domestic banks, JP Morgan, Morgan Stanley, Goldman Sachs, they suffered a lot. I think that the two things going on. One is that after they have done with the domestic banks, now they worry about us, FBOs, foreign bank organizations. We got a lot of pressures from OCC, the Fed, CFPB, all those kind of agencies. But on the other hand, though, having done 6 or 7 or 9 years of this regulation, strong regulation, a lot of firms, they spend, I cannot quote a number here because many people here maybe will quote me, but they spend a tremendous amount of money on this kind of control and regulation. And a lot of banks feel the pressure of it. Now they push back. The good news in the way that the Donald Trump administration tried to unwind some of that. But given that there's a few steps to go through from the legislation, from the guidelines, so on and so forth, it takes a few years to get there. But back to your earlier question related to the Chinese financial sector open up to foreign banks, that's significant because that will allow the foreign financial institution to go to China to do a lot of financial product, which is China is still primitive in the financial products area. Of course, we have two things to worry about. One is a wealth of financial product. On the other hand, you do not create the so-called the systematic risk control. So I think the opportunity is there for the financial institution in the US or somewhere else and going to China to provide better services to the Chinese consumers.
Okay, thank you. Joseph, let me come back to you on this because I want to get straight into the fintech area because earlier what we just discussed is really relative to your own firm and operation. But from an investment standpoint, portfolio company standpoint, fintech is something that's, I can safely use the word trailblazing in terms of in China. I believe I want to get the number right. China's mobile payment volume surpassed 5.5 billion, which is 50 times amount of money transmitted compared to the US. So it's essentially has started creating a cashless society. So in terms of your investment interests among your portfolio companies, is this a focus sector? Can you speak to the opportunities, some of the outlook, pros and cons in the coming year?
Fintech is hot across the whole world, and in China, it's also thriving. We invest into one of the largest fintech platforms. We call it a platform. As I mentioned, it's Tencent. And Tencent is now the second largest mobile payment service provider in China after Alipay. But we kind of believe it has the potential to be the largest mobile payment solution provider in the next few years. If you have ever used WeChat, you can know WeChat Pay is part of it. It's very convenient, and there are a lot more scenarios for you to use the WeChat Pay. And also, it's all free, like Alipay, but Tencent can easily monetize it. They can charge like 1 penny per transaction, but they can also still keep it free, but post a pop-up advertisement before you complete the transaction. So there are various ways to monetize from this business. And also, in terms of fintech business, there is another area that a lot of international investors are looking at. Is the credit scoring system based on the credit records. It's now closed for foreign investment, but you can invest into Hong Kong listed or US listed Chinese companies with a strong capability and database in terms of that. One example is Alibaba. Alibaba has the Taobao business, as you all know. It's the largest B2C platform in China, but also interestingly, it has the most consumer spending data and also the payment records of Chinese and now even international users. And so part of the business run by Alibaba and its affiliated companies is to do the big data analysis based on the spending pattern and the payment records, because they also provide consumer loans through its subsidiary called Ant Financial, which is contemplating IPO somewhere this year. So there are various ways for fintech companies. And another area related to our asset management business is to do the robotic advisory of an investment, stock pickings recommended by robots. This is also another area. We're skeptical about this, but there could be a way for machine learning to play in this field. We still keep our eye open on that. I want to leave it to our other panelists to comment.
Yeah, I mean, anybody who's spent any time in China and used, or any time in China, you know that you almost can't exist without WeChat. It's the first thing they tell you to do is download it when you get off the plane. And you can use it to pretty much do everything in life. I was talking to somebody who had a 100 RMB note in his wallet, and he said, this has been sitting here for the last month, and I haven't touched it because effectively pay for everything through WeChat. I think what they've accomplished is incredible, but it's also a very interesting window into the future for the rest of the world. You can see a lot of the industries that I think have been built up throughout the rest of the world that are built around credit card transactions and banking and transfers and check payments, et cetera, things that they've never seen in China, have been completely leapfrogged. But as everybody knows, things like Venmo are growing here, and people are trying to transition away. If you're under the age of 25, it's probably all you use is Venmo. There's all sorts of other industries that will be impacted on the short side. So if you're able to short stocks in the West, this is sort of a preview of what's going to happen. And I think that's a whole other angle that being able to look into China and see the future provides.
Right.
Well, let me comment on, since the fintech is important and will continue to play an important role in our society. As a matter of fact, my PhD dissertation was on machine learning, AI. So I've been through a few cycles already. Many years ago, they talk about AI, the machine translation will replace all the translators in the United Nations. But guess what happened? Did not happen. So this time around, there could be another hype going on. I realized when the machine speed exceeding certain limit, they can do certain things. But AI, in my mind, will never replace humans. A certain aspect they cannot do. But again, if you invest in a lot of buzz, even just last weekend, someone said, "Hey, Yang, why don't you go to China? Since you study AI, go to startup, you get hundreds of millions of dollars of it." I said, "Well, I think that's a hype." So if you have longer-term perspective, invest a little bit, PE fund is fine. But right now, it's a little bit of hype going on. I want to caution about that. If you have hard money, nothing to do with it, okay, put it in there.
I might differ with Dr. Ma on the AI. I know that my car can self-park much better than I do in terms of parallel parking in New York City. So.
Can your AI program draw art for you and play music? Or eventually they can do.
You know, I think this is a great segue because one of the last sector I earlier mentioned I want to talk about is AI, is how China, the progress, they're becoming a dominant player, right, in the area of AI and electric vehicle, right? And they've been, from an overseas investment standpoint, they have been make tremendous effort going around the world looking for technologies that they can acquire and bring it back to China and literally actually taking it few steps ahead. So I would love to get some additional color on that in terms of that particular sector. Aside from the self-parking part, which everybody knows, a little bit more advanced.
I want to add some hard evidence. Alibaba invests into machine learning and into the latest technology they invest into is to use the machine to understand documents.
Yeah.
The latest computation between the Alibaba's AI team using machine reading comprehension versus the Google team. The Alibaba team, actually the accuracy is higher. I forgot exactly. I think it's 80, the score is 86 versus 80, mid-80s for the Google team. And the manual team, the human team, the score is the lowest, 82 something. It's not reading one articles. It's the document database of Google of hundreds of millions of books stored in the Google system. So, and it's an examination based on those hundreds of millions of documents. The same questions for the Alibaba machine team, Google team, and the human team. So those are contrast. I'm not saying Alibaba is the best, but this is one of the results what I recently read.
Okay. Well, actually, before I want to get Eric's input on this because during my phone call with the panelists, Eric brought up a really good point in terms of what his firm is doing, is the fact that you have some of these sectors we just talked about are very, has high focus on, and China is doing very well in. Eric's brought up a point that there's a lot of peripheral sectors that his firm pays attention to. Essentially, they're the suppliers, if you can, maybe you'll correct me, to the sectors that are the focus from the Chinese government.
Yeah,
and your firm has been making investments.
Sure. I mean, one thing that we've learned over the years is that in China, a lot of times the government will come and decide that there's a certain industry where it wants to dominate. Electric vehicles, I think, is a very interesting one where a lot of big pronouncements have been made. Obviously, the largest producer in the world of electric vehicles now. And when that happens, most industries have a cost of capital. In China, what we've observed is when this happens, the cost of capital basically goes to zero, and those industries are willing to tolerate a lot of losses in order to build up the scale and the dominance in that space. The other thing that happens is because it takes too long to develop the intellectual property domestically, they'll go out and they'll buy the equipment from others, and they'll pay a very high price. You saw this like in the flat panel display sector, where they're building up a lot of capacity for OLED screens. They've gone to Korea. And I've heard about people getting paid 3 to 5 times their salary in Korea to come over to China to help build that industry and get it started. But in the electric vehicle space, there's so many, it's automotive obviously, there's so many components. When you think about batteries and what goes into a battery, all the different pieces in there, you've got a separator that separates the anode and the cathode, you've got raw materials that are, many of which have to be mined. There are many suppliers around the world that have to supply into that. And you can find a lot of them in Korea, Japan, Taiwan. We specialize in small and mid-cap companies, so they tend to be in that $500 to $2 billion market cap space. They're relatively off the radar, but they are in a position to really benefit, especially where they have dominance in one particular space or niche. And these cycles can last a long time because it takes a long time to build up these industries. So in the electric vehicles, the components within the batteries, et cetera, A lot of that technology is still being brought in from overseas. It'll eventually shift, and what you'll see is once China does dominate that space, prices will start to go down a lot because they'll build a lot of capacity, they'll get the scale. And many of those companies that are overseas that were benefiting on the upside, as capacity is built domestically, they begin to struggle once the prices start to fall.
Kenny, with you, your firm, you're overseeing more investments out of the Asia Pacific, much closer to the mainland. Any perspective that you would like to offer on this particular topic?
Yeah, I think that's a very interesting comment by Eric, because when I look at the whole EV space, the opportunities that you can look for in terms of investment is actually quite a handful. Like for example, in one of the batteries for the EV, one of the raw material is needle coke, and you can actually get a very prominent Korean company. It's not a very big company, but you can actually find such names that you can invest into, and that would actually benefit from the scale of the EV volume in China and globally. Like on the other hand, like for example, just a very simple thing for those EV, they need a lot of lenses, for example. Who are the big manufacturer of those lens module, camera lens module? I think those are also very interesting opportunities that start from Taiwan, for example, but now has also gone into the mainland Chinese space, whereby I think there are people who are learning the technology and ramping up to scale. So I think some of this ecosystem, we kind of exploit the whole entire ecosystem to find investment opportunities in that space, and that also applies to other fintech companies.
Joseph, anything to add before we?
Yeah, I just want to quote something by Bill Gates about, not specifically about fintech, but broadly, he says something like, people tend to overestimate the impact from new technology for the next 1 or 2 years, but underestimate the impact for the next decades.
Yeah.
I think it applies to fintech
Exactly.
and also the other EV, such as EVs.
It's always good advice from Bill Gates. We're coming up on the clock, so before we close out, just one last question that I would love to get everyone's input is that with the overall tone on the fiscal and monetary policy in China remains as being, what's the word they use, prudent, right? And that what do you see in terms of major trends, if there's anything, in looking ahead in 2018 or even into 2019? Are there any areas that you certainly would like to, for example, avoid? General thought, just.
Well, let me.
We're trying to take the opportunity to see how we can pick your brain on opportunities, obviously.
I will let those guys come on the China market, but let me talk about the US market. I have 2 longer-term worries, 2 short-term worries. 2 longer-term worries, one is geopolitical, which everybody knows, and the second one you may not pay attention too much is cybersecurity. A few weeks ago, you all know, everybody in this room, your phone is being affected by Intel's the chip problem. Yeah. So therefore, the cybersecurity is hidden, it's there, it's monster when it becomes the problem, and everybody will be impacted. That's 2 longer term. 2 short term one, which impact your personal investment as well. One is inflation. Inflation could go up in the US more than you think, because the labor market is already at the 4 employment rate, 4.1% unemployment rate is considered by the Federal Reserve as for employment. The wage pressure will go up. The second one is the Federal Reserve may not tight the monetary raise interest rate fast enough. So eventually, after the stock market is the trough is March 2009. So it's about how many years you can count on it. So those 2 things, rising inflation and the Federal Reserve not tight enough, could lead to the stock market correction everybody looking for. Nobody's looking for that?
This is what happens when we get a banker on the platform and we're risk managers, right? So, okay.
I'll give a slightly more positive. I think the whole key word is prudent. I mean, China, prudent monetary and fiscal policy. To me, what exactly does it mean? It means to me not too tight, not too loose. Why do they need to do this is for a very simple reason. Because the China economy is undergoing a restructuring phase. So whether it's deleveraging, de-risking, we are seeing growth slowing down. As what the economy macro panel has talked in depth about. So I think we are not going to see China growing at 8-10% anymore. So it's more like the 6 to 7% growth. And of course, to spin a better story behind the slower growth is quality growth. So we are not growing for the sake of growing, but having quality. So I think in that regards, they have to be very careful about not having this growth suddenly go down too quickly, that we call a hard landing. So as a result of that, you need monetary policy to be loose, tight at times, and fiscal policy to sometimes help out in terms of making sure that the growth doesn't suddenly decelerate significantly. But what opportunities does that present? I think that to me as an investor is more interesting. I think the financial sector is very hated by a lot of investors. We talk about Chinese banks. When I came to the US 2-3 years ago, it's like, don't talk to me about Chinese banks. All the numbers are fake. NPL is not at 1%. NPL is like whatever.
Not that I even joined the Bank of China. So.
Sorry. So I think the key question to me right now is that with de-risking, deleveraging, or a better balance sheet in the corporates, whether it's SOE or private enterprise, I think we are likely to see that the kind of worry being slowly diminishing, and as a result of that, I think there are investment opportunities in so-called the higher quality Chinese banks. So I wouldn't mention any names, but
Bank of China, can name it so.
So I think that there's one sector that I think is interesting. The other sector, like insurance, for example, you talk about healthcare. Stephen talked a lot about healthcare, social safety net. I think that is also something, as an aging population in China, that is a sector that will continue to grow very, very rapidly. So there will be opportunity, for example, in the insurance sector. And last but not least, we talk about AI, we talk about robotic, I think technology. So one of the investment team that I encourage you guys to look about is technology leaders. I agree that a lot of the AI could be a lot of concept right now, but look at the established technology leaders like Tencent, Alibaba, and all the others. I think there will be investment opportunity around that space.
Thank you. Eric?
I'd mention the first thing I think is that when you talk to most people in in the New York fund management community or Boston or US for that matter about the A-share market, most people couldn't hardly name you a single stock that trades there. And there are thousands of companies there. It's a multi-trillion-dollar market. It has not been closely looked at, hasn't been scrubbed. The opportunities haven't, I think, been ferreted out. And there are undoubtedly a lot of great, interesting companies there that haven't been closely looked at by Western investors anyway. I think that even in Asia, most folks have not spent much time looking at the Asia market. These changes that we talked about earlier, more and more people will start to take a look. If you're managing global money, if you're managing to a benchmark like the MSCI, you're going to have to because it's in your benchmark now. And just that added attention, I think, will at least slowly begin to make that market more of a market that is part of portfolios, and that's going to be a good thing over the long term. The other thing I would say is in terms of investing in China, as I mentioned, we do a lot around what's happening in China. I don't think enough attention's been paid to what's happening on the environmental side. This is a change, I think, that's pretty new. They've talked a lot about environment over many years, but this is really the first year that we've seen the government put people out on the street and actually shut down factories because they were polluting. We've seen very real impacts in all sorts of little industries around the globe as a result of this. Things like refractories, bricks that line the insides of furnaces, and graphite electrodes, et cetera. Oh, I'm out of time, sorry.
Yeah, we're out of time, and unfortunately we have to move on. So thank you so much, and especially for those of you who came all the way from Asia. And
Thank you so much.